Let's bring in George Tsilis, Senior Markets Correspondent. George, we're talking AVGO. The stock's pulled back this month along with a lot of the tech names, but it's still up about 47% on the year. What's your take here? They got the partnership going with Google's cloud business today announced.
Well, I think my take on Broadcom or AVGO, however you want to put it, is you gotta include this company in the Magnificent Seven. I think you have to start looking at Magnificent Eight because this company is a behemoth with market capitalization close to $400 billion. I think it's one of these overlooked companies that people don't recognize as a technology powerhouse. Now, if you think about artificial intelligence, you have to think about the networks that support artificial intelligence, and that's where the strength of Broadcom really lies. It's basically a world-class targeted infrastructure and software, and of course semiconductor company. But what they've done in the past decade or so is they've integrated alongside their semiconductors, which support things like 5G networks, if you will. They also support Wi-Fi networks. But at the same time, they've really morphed themselves into a software and securities-based company, not to mention the acquisition last year of VMware of $61 billion brings them into network in the cloud. And I think this is an interesting company from the standpoint of its partnerships. Recently added additional partnerships with Google in cybersecurity. But if you look at the customers that utilize their the network solutions and security solutions business, it's effectively all the mega caps, including NVIDIA, Google, Meta Platforms, Microsoft. They all use AVGO's technologies, and it's really a global powerhouse. And I think this is a very interesting company in the backdrop because it doesn't get a lot of attention, and I think it should.
You know, George, they came out with a statement saying that AI chips would generate about 25% of their future revenue. Yep. But the question is, the risk here, do they have concentration risk? Their top 5 customers are about a third of their revenue. Apple's about 20%. We know that Apple's been trying, unsuccessfully so far, or with minimal success, to bring some more of their chips in-house. Do they have concentration risk? Is it too many big customers across their landscape?
I think at the end of the day, if you look at the large customers that utilize Broadcom, I don't think it's necessarily because of their core semiconductor business. Apple's always been trying to establish themselves and produce their own Wi-Fi chips and, of course, their broadband chips, 5G chips, if you will. They can't. And they've sort of conceded that to Qualcomm because every few years they re-up their contract with Qualcomm. Now, Qualcomm is a competitor of Broadcom, so you have to keep that in mind. But I think at the end of the day, I look at Broadcom as now a completely vertically integrated company, targeted networking solutions across multiple platforms and technologies. So I think their large customers use Broadcom for a reason. I think it's an established player in the space. I think the VMware acquisition makes complete sense, not to mention the fact that cybersecurity is integrated in their network solutions business. So I think it's an important company for all these major customers, which include, of course, Apple, Meta Platforms, and Google. I don't think there's another competitor that they'll go with, to be honest with you, because of the broadness of their business. Now, one of the things you have to keep in mind, obviously the stock price has done tremendously well this year. It's basically moving in sympathy with companies like NVIDIA. One of the things to keep in mind, I found, is if you look at Broadcom, in terms of its profitability, it's remarkable. I mean, it's the most profitable at 39% net income margin of any of the major mega cap technology names, besting Google, Meta Platforms by double, even Apple. So I think if you look at it, its growth rate on a forward basis is only about 14% earnings growth. And so it's mild to modest growth, but extremely profitable business. And it's not trading more than 1.5 times its EBITDA. And I think it's a valuation company as well, value-based company as well in this environment.
All right, George, we're going to take it and run with that research, or not research, but background that you did here on AVGO. Appreciate it. That's George Tsilis, Senior Markets Correspondent.